Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about MillerKnoll Inc. quarterly report. MillerKnoll Inc. maintains a market capitalization of $1 billion, broadly in line with the industry peer group. MillerKnoll Inc. trades at a lower price-to-book ratio of 0.97 times relative within the industry. But when we look at the broader industry, much for its peers are also priced fairly or higher. This indicates an overall sector-level optimism, suggesting that most investors have already participated in the industry, leaving limited opportunity to uncover undervalued stocks. The company maintains a moderate leverage profile, with liabilities making up 66% of total assets, suggesting a balanced approach between risk management and capital efficiency. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. Shareholder equity has declined over the past 5 years, but operating income remains positive. The equity weakness may stem from capital structure changes such as buybacks or dividends rather than operational deterioration. The company has consistently reduced its share count while revenue has grown, but declining assets and equity suggest buybacks may be taking precedence over reinvestment. The company have a dividend yield of 4.08%. The income statement shows that the company have been growing its revenue annually, and the operating income have been increasing. This shows that the business model works and the business is expanding. MillerKnoll Inc. offers a wide range of businesses and services that cater to various needs and environments. The company provides interior furnishings worldwide through its 3 segments: North America Contract, International Contract, and Global Retail. The company's product offerings include seating products, furniture systems, textiles, leather, felt, home furnishings, case goods, storage products, and residential, education, and healthcare furniture solutions. These products are sold under various brand names such as MillerKnoll, Herman Miller, Knoll, Maharam, Geiger, Design Within Reach, Hay, Not One, Colebrook, Boston Saunders, Holly Hunt, Vladimir Kagan, Mudo, Fils Felt, Edelman, Spinnebeck, and Dates Weiser. MillerKnoll's products are used in various settings including institutional, health/science, industrial, educational, residential, and other environments. The company offers its products through multiple channels such as independent contract furniture dealers, direct contract sales, owned and independent retailers, direct mail catalogs, and e-commerce platforms. The stock price of MillerKnoll, Inc., MLKN, has experienced significant drops in the past year due to several key events. One major factor was the organizational restructuring and special charges announced on March 26, 2025. This announcement led to a $140.2 million charge for restructuring actions and goodwill impairment, causing the stock price to drop further. The Cone Fiscal 2026 earnings report, released in September 2025, also contributed to the decline. Despite reporting a 10.9% increase in revenue and earnings per share of $0.45, investor sentiment was negatively impacted by the company's guidance and plans for new stores. As a result, the stock price plummeted from around $22 to approximately $17, representing a drop of about 22.7%. These events have cumulatively led to a decline in MillerKnoll's stock price, exceeding minus 13.92% in the past year. The primary drivers of revenue growth or decline can be identified through an analysis of the company's financial performance. On the positive side, revenue growth was driven by several factors. In the United States, revenue grew by 5.6% in the first half of the year, while the global retail segment reported a 4.7% increase in net sales on a reported basis and 3.4% organically in the third quarter. The North America Contract segment also saw new orders increase by 4.8% from the prior year. In addition to these regional drivers, favorable channel and product mix contributed to growth, resulting in a positive impact on margin. On the other hand, revenue decline was primarily driven by decreased sales volumes in the North America Contract and International Contract segments. The North America Workplace Contract segment also saw a significant decline of 4.3% in the third quarter. Overall, the company's revenue performance was mixed, with growth in some regions and declines in others. However, it is clear that regional drivers and changes in sales volumes were key factors in determining revenue growth or decline. The net income of a company underwent significant fluctuations between 2024 and 2025. Initially, it decreased from $34.1 million in the 3 months ended November 29, 2024, to minus $3.2 billion due to higher interest expenses and lower operating earnings. However, this trend reversed as the net income increased to $24.2 million by the end of the period. For the 6 months ended November 30, 2024, the net income showed a more positive trend, increasing from $32.9 million in 2024 to $44.4 million. The profit margins also experienced changes during this period. The gross margin initially increased by 20 basis points, but later decreased by 0.7%. However, it eventually recovered and increased by approximately 20 basis points due to leverage on fixed costs. On the other hand, operating earnings as a percentage of net sales declined from 6.3% in 2024 to 5.1% in 2025. The reasons behind these changes were multifaceted. For instance, the decrease in net income was attributed to higher interest expenses and lower operating earnings. Conversely, the increase in net income was due to improved operating performance and lower interest expenses. The profit margins were affected by reduced sales and profitability projections, as well as an increase in the discount rate. Additionally, decreased sales volumes, incremental discounting, tariff-related costs, and unfavorable foreign currency translation also contributed to the decline in profit margins. The fluctuations in net income and profit margins highlight the complexities of a company's financial performance. While there were periods of improvement, such as the increase in net income for the 6 months ended November 30, 2024, other factors like higher interest expenses and reduced sales volumes had a negative impact on the company's bottom line. The company's financial performance is a testament to its ability to generate positive operating cash flow. According to the latest figures, for the 6 months ended November 29, 2025, the company recorded an impressive $74 million in net cash provided by operating activities. This significant amount indicates that the company is successfully managing its operations and generating sufficient cash to cover its expenses. The data from page 51 of the report further reinforces this conclusion, stating that the company generated $74 million in positive operating cash flow for the same period. This confirms that the company's efforts are yielding tangible results, allowing it to maintain a healthy financial position. Overall, these figures demonstrate that the company is indeed generating positive operating cash flow, which is a crucial indicator of its long-term sustainability and growth prospects. The company's debt level and interest expenses have undergone significant changes over the past year. While the total debt has decreased from $2,615.1 million in 2024 to $2,583.6 million in 2025, a closer look at the numbers reveals mixed signals. Long-term debt has increased by $10.3 million, indicating that the company is taking on more long-term obligations. However, available borrowings have decreased from $382.2 million to $367.9 million, suggesting that the company is reducing its reliance on borrowed funds. This reduction in available borrowings may be a positive sign for the company's financial health. In terms of interest expenses, there has been a significant decrease of $4 million for the 6 months ended November 29, 2025, compared to the same period in 2024. Additionally, interest expense has decreased by $2.5 million due to reduced debt levels. These decreases indicate that the company is benefiting from lower interest expenses, which can be attributed to its efforts to reduce debt and optimize its financial position. Overall, while there are some mixed signals regarding the company's debt level, it appears that the company's efforts to manage its debt have led to a decrease in interest expenses, which is a positive development for its financial health. The recent financial performance of the company has been marred by underwhelming results in certain segments and regions. In North America, the contract revenue for both 3 and 6 months, ended November 29, 2025, showed a decline. The 3-month period saw a drop to $508,500,000, while the 6-month period witnessed a decrease to $1,042,400,000. Similarly, the international contract also experienced a downturn in revenue. For the 3 months ended November 29, 2025, the revenue dropped to $170,900,000, and for the 6 months, it decreased to $338,400,000. These declines indicate that these regions require attention and improvement strategies to boost their performance. Management is optimistic about the company's outlook, citing opportunities for growth by leveraging its collective brand equity across various lines of business. This strategic approach aims to maximize the value of existing assets and expand market reach. In terms of product development, management is focusing on creating solutions that cater to highly functional and productive settings, as well as ergonomic seating needs. These efforts are expected to drive innovation and improve customer satisfaction. The company's financial performance is also expected to remain stable, with no significant impact anticipated from the adoption of new accounting standards. Management is committed to realizing synergies through integration charges and reorganization initiatives, which will support long-term growth. In terms of capital expenditures, management plans to fund commitments using cash on hand and operations, with projected full-year purchases ranging between $120–130 million. This strategic approach ensures that the company maintains a healthy balance sheet while investing in key areas for future growth. The company has a history of returning value to its shareholders through both dividend payments and share buybacks. In recent years, it has paid out significant amounts in dividends, with $25.6 million distributed in 2025 and $26.2 million in 2024. Additionally, the company has also been actively buying back shares, with a notable reduction of 44 shares in its outstanding count. These actions demonstrate the company's commitment to rewarding its shareholders and maintaining a strong financial position. Concerns have been raised regarding the buildup of inventory. The data suggests a significant increase in finished goods and work-in-process inventory between May 31, 2025 and November 29, 2025, amounting to $30 million. This surge in inventory levels can have a ripple effect on working capital, as fluctuations in inventory can impact cash flow and overall financial stability. That concludes the financial summary for MillerKnoll, Inc. Feel free to comment below, and I will be happy to answer them when possible.